Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, we're recording this podcast at the end of a fairly eventful week. We now know that Trump has won the US presidential election, so unsurprisingly, investors are very focused on what this could mean for the new US administration's policies and hence the outlook for both the equity market as well as US bond yields. Now, the US election wasn't the only big event in this very packed week. We also had central banks in the US and the UK meet to set policy. And of course, we got rate cuts from both central bank meetings this week. So, how should investors factor all of these events into their investment decisions? To discuss this and more, today I'm happy to be joined by Audrey Go, who's head of asset allocation at the CIO office. So, welcome, Audrey. Thanks for joining us at the end of what's been a very eventful week. Let's talk about the elections first. What do you make of the outcome, the proposed policy agenda, and what do you think it means for markets?
Well, thanks, Manpreet. Markets have been factoring in the return of Donald Trump to the White House over the last couple of weeks. However, they were not expecting a decisive victory, as polls were showing a very tight race even up to decision day. So, given this, we have seen Trump-related trade saw another leg up as his Republican Party swept the presidential election, took back control of the Senate, and also looks likely to retain control over the House, a so-called clean sweep. Trump is also only the second Republican president since 1992 to win a majority of the popular vote, which means he has the mandate to implement his political, economical, and foreign policy agenda. Now, his policies are broadly aimed at reviving US growth through tax cuts, deregulations, and protectionism. Hence, they are likely to be quite positive for US risk assets and the dollar at the expense of non US assets, at least in the near term. So, given this, we expect stocks to outperform bonds, equities over non-US equities over non-US equities, cyclical over growth as well as defensive equities. The likes of the US dollar, US small cap, value style related stocks, financials, aerospace and defense are also expected to perform better under the Trump administration. Now, how these policies are eventually sequenced are also very important for markets. If you look at the Republican agenda, it largely focused on tariffs, immigration curbs, tax cuts, and deregulations. Of these, the first two are likely to be inflationary, at least in the near term, if the party chooses to focus on protectionist policies by raising import tariffs and deporting illegal immigrants in an economy which is facing labor shortages. Now, conversely, if the Trump team decides to focus on tax cuts and deregulations first, then this will likely be positive for consumer and business confidence, therefore lifting risk assets.
All right. Well, what about bond markets? We know bond yields spiked right after the election, and we just concluded a Fed meeting where they cut rates. In your view, how would the election outcome? Is there room for it to sway future Fed policies, and how should investors react to the spike in bond yields?
So long-term bond yields have risen ahead of Trump wins in anticipation of higher deficit as well as increased U.S. Treasury issuance that some of his policies imply. However, the U.S. 10-year bond yield have not reached the previous high seen in April, which suggests that while long-term inflation expectations may have incrementally increased, such outcome and such concerns remains relatively contained. And the Fed has also continued to cut rates this week, implying that it is not yet concerned about Trump's policy. Fed Chair Powell himself said it is too early to know the timing or the substance of what fiscal policies may come. But nonetheless, money markets are now pricing in another 90 basis point of rate cuts by the end of 2025 from more aggressive expectations prior to Trump election. We believe that market focus will quickly return to economic data, and in this context, we would take advantage of the current yield spike to average in for attractive income. And the key risk to this outlook is that therefore a larger than expected Trump fiscal package, which could then reignite inflation fears, hurting bonds.
And finally, let's talk about currency markets. Alongside, it wasn't only just bond yields, but the US dollar also strengthened quite considerably, both in the lead up to and after the election. Do you expect that to continue? And I suppose the related question is, what does that mean for major currencies like the yen, euro, and the pound sterling?
So the FX market has largely factored in the Trump trade narrative. The US dollar index, or the DXY, has surged to a 4 months high and therefore could see some profit taking near term. The 1 month implied volatility in the DXY has also reverted to its 5 year average, reflecting a more stable sentiment. And technically, the 100-day moving average at 103 offers good support, and we do see further upside beyond that towards the 106 mark, which is the July's peak, where we deem as a pretty strong resistance level. In terms of US dollar yen, we expect it to range trade probably between 147 to 158 in the near term. And beyond the very short term, fundamentals is likely to return back to center stage. And a US dollar break to the upside is only likely if US economic data is considerably more resilient than expected, therefore resulting in expectations of a slower pace of Fed rate cut, which is a risk that we have to monitor. And on euro dollar, it has slipped to a 4 months low given the narrative around US election. Technically, the pair is near oversold levels, which suggests for potential for a moderate rebound in the coming 1 to 2 weeks. It remains to be seen if the ECB may respond more aggressively than what the market expects to potential US tariffs, which will then suggest risk in terms of a widening rate spread, adding downward pressure on euro dollar. At the moment, money markets are now anticipating about a 80 basis point cut by the Fed and around 120 basis point cut by ECB from now through to September 2025. And the case of pound, similarly, it has also weakened after the dollar surge. And following the Bank of England expected 25 basis point cut to 4.75%, given the backdrop of cooling PMI data as well as CPI, the pair upside is likely to be capped near its 50-day moving average at around the 1.31 mark. The 1.267 remains a decent technical support, and that which is near its August low. Other than that, we see the pair largely trade within this range with some bias to the downside.
All right. Well, I think we'll bring the podcast to an end at that on that note, keeping it short and sharp. Thanks so much, Audrey, for taking the time to join us today. Key takeaways, I think the top three from my perspective. I think one is the Republicans' proposed policy mix for risk assets. Does depend on their priority order. If we get an initial focus on pro-growth policies, we believe that'll be good for risk assets. The second point takeaway, of course, on bond yields, we do see the spike in yields offering an attractive opportunity to lock in income for the long run. And finally, the dollar strength, the July peak will most likely act as a strong resistance. So even though the euro may rebound from oversold levels in the short term, that could create an opportunity to sell the currency on rebounds. So thanks very much, listeners, for taking the time to join us today. We'll sort of bring the podcast to an end at this point, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.